All right, CIT filed for bankruptcy protection yesterday. The 101-year-old lender has borrowed over $2 billion from U.S. taxpayers alone. Brian Charles, debt analyst at RW Pressprich, looks at what options unsecured bondholders have in a bankruptcy, and he joins us now to talk about really the whole picture. Let's start, though, with the first question. Does the U.S. government, does the taxpayer ever get paid back here?
Well, as the current plan has been passed, it doesn't provide for much upside for the government investment. They would have to realize substantial value in the unsecured notes that are issued as part of the plan to bring into play these contingent value rights that might ascribe some value to the preferred stock. But I don't think that's likely. I think the market value that these new notes trade at won't be enough to create any contingent value rights.
All right. What about the options for the unsecured bondholders?
Well, the bondholders overwhelmingly approve the plan, and as the plan dictates, they will receive new notes about 70 cents on the dollar for their pre-petition claim, and they will get the equity residual value for the company, or what is in the company, over the next several years as it plays out its plan. It will either be a runoff of its current portfolio or a development of its bank strategy. And while a bank strategy might have its own risks, at least it will be subject to regulatory oversight. So to the extent that the bank really grows, I think that will probably entail some considerable equity value if they're able to grow the bank.
Let's talk about the possibility of that happening. I mean, last week, a lot of people were saying if CIT survives, it's not a very likely scenario. Now it seems like they'll continue to lend and deal with their clients on a regular basis going forward.
Well, they've isolated some businesses in which they'll try to support growth going forward, the trade finance and the vendor finance business. Meanwhile, they've pretty much acknowledged that the corporate finance business should be in runoff mode, and the transportation finance business, which is not a great business to run out of a bank platform, will probably be in runoff mode. But in order to grow their businesses that they've targeted off the bank platform, they really need to grow the deposit base and come up with a strategy that meets the approval of the regulators to grow that deposit base.
Is that going to be tough to do in this environment, Brian? Because I'm thinking folks are going to be kind of hesitant about doing some more business with CIT because it seems like the future is still, there's a lot of questions out there for the company.
Well, fortunately, the recapitalization of the company will give it better capital ratios than it's had, I think, in its entire history. That might give it some...
better? Is better great or just better?
I'd say substantially better, to the tune of 15% total capital or more, depending on how the balance sheet is restructured after the company emerges from bankruptcy. That might provide the company with enough confidence from the regulators that the regulators do pass on their plan to try to grow the deposit base. Given that type of confidence, it might engender some confidence among their their customer base, not to migrate away from the company, but to stay with it.
Will they be then, after this bankruptcy, free also of any government intervention here? Because we did a story today about Ally Bank, GMAX Bank, having to bring down its interest rates. It was trying to boost its customer base as well, and the government said, hey, not so fast.
That will be an issue. I think the company will be subject to a lot of regulatory oversight, / government intervention going forward. And to the extent that perhaps there is a recast of what the equity distribution in the bankruptcy plan ultimately is in terms of what kind of recovery the government preferred can receive, that might leave the government an owner, a part owner of the company as well. I'm not ascribing a high likelihood to the possibility that that actually happens, but regardless, I do think the company will be subject to pretty strict regulatory oversight.
Is it going to be a pretty quick reorganization in your view?
Hopefully. The prepackaged plan, given these creditor support, which was essentially 90% of everyone who voted on the plan, and the plan itself got 85% participation, 90% of them approved the plan, that should allow a relatively smooth bankruptcy proceeding, hopefully a couple of months.
What if you had to go back and say one major mistake that Jeff Peake made? Where did they go wrong here, CIT? What would you say?
Well, CIT has operated in commercial and consumer finance business over its history, but they did make a stab into consumer mortgage finance over the last, well, I guess several years, in the beginning of this decade. That ended up costing them as the mortgage market fell. And their the foray into student lending business ended up being a business that was a relatively low margin business. They decided to put that into runoff. And unfortunately, they do spend a lot of their business and a lot of their time financing relatively small commercial customers that may have relatively volatile credit quality throughout economic cycles. And this economic cycle and this credit downturn was just so severe, it was tough to emerge from that intact.
So are you saying unusual circumstances for CIT, and that's what kind of got it into this position, or also some bad decisions way back when?
I think some aggressive decisions and some circumstances that were out of their control in terms of the economic cycle.
Caught in the perfect storm then, rather than...
Essentially.
What about going forward? I mean, will they learn from this? Do you think you say they're much better, in a much better position as far as their capitalization?
I think they will learn. The top management is being turned over, and the board is going to be substantially turned over. So I think, yeah, going forward.